Hello everyone, and welcome once again to the Master of Money program. I'm Steve Beeman, your host, and I am so pleased to have you with us tonight, whether you're joining us live in our Oak Brook studios at the offices of Harvest Investment Services, or you're joining us through Ustream, through one of the many sites that carry this program. We're glad you're with us. We hope that it meets your expectations every week for providing the best content available. We live in a very tumultuous time, you and I. Global transitionings are happening to the economy, and many institutional investors don't know what to do with the money they have. Well, where does that leave you? Well, we exist to provide you the knowledge you need to know what to do with that hard-earned money, and we hope that that information can help you build a better path to prosperity. As one of our members recently told us, you've got a friend in financial services. Well, we're glad you're with us. Tonight's program is going to be a little more advanced than some. We're going to be talking with you about option strategies. These are things that are frequently used by institutions, but frequently misunderstood by individuals. So it's a little more complicated perhaps than some of the programs that we have, but we want to go through it tonight. Whether you're a person who might consider using options in your portfolio, or a person who would never touch that, this is part of building the overall financial literacy that you need to protect you from people taking advantage of you. So we hope that you'll enjoy tonight's program on options. Now, last week we talked with you about momentum strategies. We talked about how momentum with the investment world can be used to enhance your returns, to build better returns, whether you're a value manager or a growth manager. And momentum can also be used to provide a hedge for you. In other words, downside protection. A number of managers now have moved away from a buy and hold mindset into a tactical mindset where they don't mind coming out of the market and into cash. Momentum can be a key factor in helping you understand when you should be out of the market. And with all the tumultuousness we now see around the world, well, it never hurts to have some of that in your repertoire. So we talked about the good, the bad, and the ugly of momentum. We shared with you that some of the trading systems that are frequently used don't always work in real time, although they may look good in the rearview mirror. When it comes to what you do in the next day's performance, well, they may not live up to your expectations. As you go through that, we always welcome you to write to us at questions@safefinancial.org. That's our email where we take viewer questions and member questions and help them understand the complexities of the financial and economic world. So we urge you to write us, once again, questions@safefinancial.org. We also welcome you to visit us on Facebook, where we have a page. That's Society to Advance Financial Education on Facebook. Or you can visit us on Twitter, where we're The Safe Society. Wherever you get a hold of our content, we hope that it brings you a better beginning and final end or path to prosperity. So we're so glad that you're with us. Now, last week, after we finished the program, we do entertain questions from all over the world on the Master of Money. And we had a question that came in related to a Master of Money program we did a few weeks ago. And that was a question that said, what's happened to gold? Why has it come down so systemically from 1,500 down to around 1,100 where it is today? Well, the reason for that is a multitude of things. Number one, the United States economy has gotten stronger. For the last 2 quarters, we've seen robust economic growth in the United States. Now, we can never be sure whether that will continue, but to the extent it does, we are outperforming the rest of the world. We've seen real slowdowns in Europe and in the Far East. All of that leads the U.S. dollar to once again be the most valued currency. That's a driver to the price of gold. When people are looking for a safe harbor for their money, well, they're going to the old greenback. Now, in addition to that, in the last month or so, we've seen a dramatic decrease in oil prices. This has been driven by the fact that the American shale oil industry is now producing so much gas that we're the world's largest producer. Well, that has caused oil prices to come down, which again is fueling strength in the American dollar. So it's really those two things, the strength of our economy and the fuel prices, that have led gold in the near term to come down. But as we've said before, if within your portfolio you've bought some gold and you hold it as an ultimate inflation hedge, Well, don't sell it or think of selling it just because the price is down. You might want to actually use it to boost up a little position in gold. I mean, after all, if you still believe inflation is on the forefront, well, gold, as we've shown you, is a pretty darn good way to hedge against inflation. So we've talked about gold, we've talked about how to trade it, we've talked about how to hold it, and we know that whether you're buying it for an inflation hedge or as a trading vehicle, gold can become a valued part of your holdings. So to that viewer, we hope that we've answered your question. If you go onto Ustream, that's our video carrier, directly at ustream.com, and search for the Society to Advance Financial Education. I think our name on there is safefinancial.net or Safe Financial. What you'll see is what we call the Safe Insights reports. These are little 2.5 to 5 minute briefs that we do periodically, and we just put one up on Ustream directly related to gold. So we'd urge you to visit us at safefinancial.org or up on Ustream at Safe Financial there, and you can get those additional reports. Now, in the geopolitical world, as we do every week, we try to bring you up to speed on what's happening out there, and it never ceases to provide ample cannon fodder for this broadcast. This last week, we saw this meeting in China of the nations of the world who came together to talk about global growth. Now, there are many issues that came up there. Number one was carbon emissions. Well, our president, President Obama, made some very, very grandiose statements about limiting American carbon production. Well, that has the business community up in arms because the limits that he talked about would be demonstrably bad for American business. Well, we want to keep an eye on that as we go forward and to see whether or not Congress will approve some of these things to determine how that might affect the economy. We're clearly concerned with the energy sector here. The coal miners in West Virginia and those areas certainly understand the pain of these environmental regulations. So we want to watch that. But there was more to this Chinese meeting that took place. We saw Canada, for example, standing up strongly against Vladimir Putin. The Canadian Prime Minister saying to him, yes, I'll shake your hand, but get yourself out of the Ukraine. Well, we know that the drop in oil prices has put additional pressure on the Russian president, and he's reacting to that by not just showing aggression in the Ukraine, but by having bomber flights in our North American or Alaskan air defense zone. He's had bomber flights in northern NATO countries, and he announced last week he would have bomber flights in the Gulf of Mexico. Well, this saber rattling is clearly in response to the American sanctions against that regime. Well, we hope that our government stands strongly against this president so that he doesn't miscalculate our resolve to stay free. We also now know that at the Asia Cooperation Summit there were a number of trade agreements that took place related to currency manipulations. We haven't talked at the Master of Money a great deal about currency trading, but we know that the Chinese artificially keep their currency prices down. That helps their exports. And we have a lot of issues with that because as other countries want to export into China, it makes their goods more expensive. So there were a lot of talks about trade policy related to currency. We also had talks about the piracy issue going on right now in technology, whether it's software piracy or it's hardware piracy. On a very interesting side note, during this summit, the Chinese released pictures of their new air defense fighter. Well, very shockingly, that fighter just released looked identical to the F-22 Raptor, which is our state-of-the-art next-generation fighter. Did they steal the plans for the Raptor? Well, it's awfully coincidental that they look identical. So we know that this issue goes on, and piracy in the software world's been going on for a long time. But it came up in the Asian Summit. We hope that our government will move forward to build stronger and stronger protections for U.S. copyright holders. And finally, we talked about, yes, global warming. I mentioned that the president put in or discussed having some very severe limits on carbon emissions. Well, that, you and I share the belief that we want a good climate. We don't want, pollution to disrupt our way of life. By the same token, we have to balance that against economic interest of a growing globe. Well, we hope that our government shows restraint and not simply unilaterally goes about putting in carbon limits that detract from our ability to have a strong economy. Our people need jobs here, especially with the growth in the immigration sector. So we need to be putting jobs out there, not losing them to overreaching carbon issues. So we hope that the administration, again, thinks wisely with that. Now, in the economic world last week, the global central banks were all approached, as I said last week, by our chairman, Janet Yellen, to start pumping stimulus money into their economies. They've seen slowdowns from Europe to Asia and China, and the only way they know out of that is to stimulate from the central bank's perspective. Well, this isn't seeming to help right now, and those economies continue to slide into what looks like recession. Japan certainly is, and we've seen Japan sliding down into what looks to be a very deep recession. So we want to keep an eye on that. As it affects the globe, our exports are affected by that, as we know. The energy sector is affected because there's less consumption, less demand for energy products. And we just want to keep an eye on the foreign countries' economies. We will each and every week for you. But right now, we want to tell people to hold steady. Don't panic. Those economies are still okay, but they are slowing down relative to the United States. Now, again, we mentioned a moment ago that the other big economic news is oil prices. We're down at about $78 a barrel right now, and that's leading American gasoline prices to go down to the $3 level. Well, that's certainly welcome news to you and me, but to the countries who live off of oil, Russia, Venezuela, Iran, you see a common thread there, not friends of the United States. Well, those countries are suffering from this. And we're seeing some different kind of moves in their parts, one of which is they've approached OPEC, the Organization of Petroleum Exporting Countries, and asked for production limits to be imposed by OPEC. Now, OPEC has, at least up to this point, said, no, we're not going to change our production output. We're going to let prices stay where they are. For the Saudi Arabians, this is a good thing because it cleans out some competition. So we'll have to see where oil prices go, but all looks ahead would show that oil is going to stay in the $78, $80, $82 a barrel range for the foreseeable future. So you can see your gas prices stay stable at about $3 a gallon. Now, as we looked at the markets, major indexes rebounded once again last week, and that's good for 401k holders, for retired people invested in the markets. We like to see that. Clearly, the market is being driven by the Fed's zero interest rate policy. There's nowhere else to go with money. Why would you put your money in bonds that are at 1, maybe 1.5%, when you can buy dividend-paying stocks paying 4 and 5%? That's clearly been the issue, and that's held the market up. I want to mention to you, though, that I saw some statistics that are interesting that we should talk about. And if you look at what's called the price-earnings ratio of the market, that's the price divided by the earnings of the companies. Well, we're trading now at about 15 times earnings. Historically, that's pretty high for the market. So that puts a bit of a concern that as interest rates go up from the Federal Reserve in 2015, we'll see the market come down in response to that. Be aware of that. Be aware that you should have some tactical application in your portfolio. Being in the stock market is a good place to make money, but you need to be in it smartly. And right now is the time to be extra smart. Look at some of the risk strategies we talked about last week. So we know that as we go forward, the markets will be what they are. They're going to go up or down, but I can tell you that with the valuation, that 15 multiple, we've got pressure on the downside, and we know interest rates are going up. So be aware of that. And then finally, in the interesting news in the markets, we talked about Burger King a while back, and we talked about how they were going to India. Well, the fact is we're seeing a growth in global export of American brands. Budweiser is now owned by a foreign brand or a foreign company. And we're seeing this more and more, and I think Americans should get used to it. It is a global economy, and major companies are trying to situate their headquarters where it makes the most economic sense. One of the problems with the American tax policy and corporate policy is we have what's called repatriated profits taxes. Now, what this means is if you have a company that has profits in Ireland, when you earn that money, you pay taxes on it, both to Ireland and to the United States. But there's an additional tax on that money when you repatriate it back into the United States. Well, that repatriation tax is what's keeping literally trillions of dollars sitting offshore. If the Congress of this country would get its head together and eliminate that real penalty tax, we could see trillions of dollars come back into the United States, which would further stimulate our growth. So we look for Congress to make a move on the repatriation tax shortly. Now, as I said tonight, we're going to dive deeper into the financial area, going through options. This isn't always the case, by the way. Next week, well, we're going to bring it way back up, and we're going to talk about ways you can begin a path to prosperity. If you've never done anything before, we've got a couple of neat tricks we're going to teach you, just very simple things you can do. But tonight, we are going to go a little bit deeper. We're going to dig into the world of options. Now, options are used by the institutional world all the time. And it's been said on Wall Street that they'll sell an option any day of the week. Well, you and I need to understand how these things work. So when we come back from our first break, we're going to talk about options. We're going to talk about call options and put options, the two basic options that are used. And we're going to go through how those can be used to hedge your risk, give you better protection, and serve as an insurance policy for you. So this will be a very in-depth understanding tonight. We're going to go through it and try to make the complex very, very simple for you. But as we go, sit back and relax and enjoy. We're excited to have you with us. We hope that this next segment doesn't fly over the heads of everyone. We're going to try to keep it at a good level for you. But thanks again for joining us. We will be right back with our message about options and derivatives.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors, because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to the Master of Money. It's a pleasure to have you joining us tonight. Now, as we discussed before the break, we are covering something that's a little more complicated tonight. They're the option strategies in the world of options. Now, these are those dreaded derivatives you hear so much about. There are other ways to play that game, but options serve at the core. And we're going to try to explain these to you in a way that helps you understand it and maybe intrigues you to start to maybe put some of your money into one of these strategies. Now, if that's the case, we urge you first to talk to your investment advisor or your broker. But if you have questions, you can always reach us at questions@safefinancial.org. Remember, questions@safefinancial.org. For tonight's program, that may become a favored email address for you. Now, sometimes what seems so incredibly complicated isn't. It's just a matter of understanding the vernacular or the words that surround a certain investment. Wall Street's famous for making words seem complicated. It's how they earn a living. but we're going to debunk some of that, and we're going to do it by talking about the two basic option strategies, calls and puts. Now, those are two words you should get to know. The fact of the matter is they're very simple, and they're opposite ends of the same coin. The call option gives you the right to buy a stock. In other words, to call it away from someone. The put option gives you the right to sell a stock or put it to someone. Both of these options have a predefined price called the exercise price or the strike price, and they have a predefined premium, and that's the price you pay for it. Think about options as insurance for a minute. Most of you own housing insurance. You pay a premium to the insurance company every month, and you hope that you don't have to exercise that premium or that call. You have an option, again, to use the insurance if you need it. It's a call option. Hopefully you won't, though. So that you don't mind paying that insurance premium. The same is true of auto insurance. You pay a premium for a call option to fix that car if you get in an accident. Well, options work very much the same way. You're buying the privilege or the right to do something down the line, and you pay a premium for it. Now, I'm going to go into calls and puts, but we welcome you. If you have questions about this, don't forget, questions@safefinancial.org. Let's talk about the world of call options first. These are a little more simple because both sides of this coin can be used by you to both enhance returns as well as mitigate risk. But let's take a look at a first example. Let's assume for a minute that you want to buy a stock or a different financial instrument, and the price today is $50. But you, for whatever reason, you can't buy it for 60 days. Well, now during that time, you're afraid the price might go up. You're afraid that $50 stock might go to 60. Well, you don't want to pay 60 for it just because you can't buy it. So what you can do is go into the marketplace, and these are very liquid. They're all over the place. And you can buy a call option. And what that is an option in this case that gives you the right to buy that stock at 50 for the next 60 days. So 60 days from now, if you go out and you want to buy that stock and it has risen to 60, well, because you bought that call option, you can go out and buy it at 50. Not a bad way to ensure that you got the price you wanted. Farmers have been using strategies like this for years to hedge crop prices. Well, the fact is you can use it to hedge your stock prices too. So in scenario number one, a buyer says, I want to own a security, but I want to own it down the line and pay a predetermined price. They would buy a call option. It's pretty simple. Now, the other side of that coin is called selling a call option. It's obviously the opposite. You sold it rather than bought it. But why would you do that? Well, let's assume you own a stock and it's at $50. And you're thinking to yourself, I don't mind getting out of that stock, but I'd like to get a little more than 50. Well, what you might do is sell that call option to the buyer for that premium. Let's say it's $2. And now, when they call that stock away from you, if they do, they pay you $50 plus they pay you $2 in premium. So you got $52 for your stock. Now, if the stock doesn't go up past 50, they may never exercise that call option, and you just keep the $2 free and clear. It's an insurance policy that never paid out. That's called covered call writing. I'm going to talk about that in a few minutes. I want to spend more time on that. But these are the two basic options for calls. You can buy the call to secure a price that you will pay for an option or for the stock down the line, or you can sell the call to make sure that you get paid a certain price at a certain point in time. If you think the price of a stock is going to go down a little bit, you can hedge that by selling a call. And the math on that would be pretty simple. You have a $50 stock, and you say, well, I want to sell it in the next 60 days or so, but I don't really want to go down too low on it. What you can do by selling that call is you've hedged your price by $2. Meaning that because you now have a $50 stock and you got $2 in premium, it can go down to $48 before you've really lost any money on it. So there's a bit of a hedge to selling a call option as well as an income stream that you can generate. So you can buy call options in order to secure a price, or you can sell a call option to generate income or hedge your position. Now that's probably as clear as mud. So again, remember your best friend, questions@safefinancial.org. The other side of this are the puts. Now, if a call option gives you the right to buy a stock, well, you can imagine pretty much in your own mind the put gives you the right to sell a stock. Well, let's look at examples of why you might do that. Why would a person buy a put? Well, let's assume that you own that stock at $50 and you think the price might just be going down, but you don't want to sell it just yet. You want to insure it against the price decline. Well, by buying a put, let's say you buy a put with a price, an exercise price of $50, you've now guaranteed that you can sell that stock for $50 during the time you own the put. That's not bad. It's a nice hedge. Now, it's not perfect because there is a cost to insurance and there's a cost to buying a put. You might pay a couple of dollars for that privilege. But if you're worried about a stock dropping significantly and you don't yet want to sell it because you're expecting something or some event to happen, buying a put can hedge that bet so that you don't lose money. And not losing money is, by the way, the best way to make money in the markets. So the other side of this coin, though, and this is the most complicated of the four we're going to talk about, is selling a put. Now, selling puts is a very high-risk endeavor done only by institutions used to hedge very complicated strategies. As you can figure out, selling a put gives someone else the right to put their stock to you at a price. Now, that's a significant risk because if you sell a put at 50 and the stock drops to 30, well, that person can put that stock to you at 50 and you have to make up the difference. You would sell a put if you think the stock's going to go up significantly. That might be a time to sell a put. You can gain a little bit, but you want to make sure, this is where it gets complicated. If you sell a put against your stock to generate some cash because you think the price will go up, make sure you do something, buy a call, for example, to hedge the risk on the put. That's a serious, serious issue because you don't want to be in a position where you get taken to the cleaners on one of these puts. So we've talked briefly about calls and puts. And again, I welcome you to reach out at questions@safefinancial.org. But the idea here is to familiarize you with the terminology. Calls give you the right to buy a stock, puts give you the right to sell a stock. It's that simple. They are akin to insurance policies. You're going to pay a premium for the privilege or the right to call the stock from someone, or a privilege to put that stock to someone on the sell side. Both of these are valid strategies. They're used by institutions to hedge returns and to increase returns. When you hear about the hedge fund world, it's very, very common for them to be using these strategies. So there you have a very quick introduction to calls and puts. Now, I said I wanted to spend some time on covered call strategies, and let me tell you why. I hear a lot of radio advertisements and TV advertisements for this miracle investment strategy that can make you 2 to 3% a month on your money. What they're talking about are covered call writing strategies. The way a covered call works, and we talked about it a moment ago, if you own a stock, you sell to someone else the right to call that stock away from you at a predetermined time. Okay, that's fine. That's a very low-risk way to make some income. Well, there is downside to this, though, and I want you to be aware of it. While selling the call incurs no risk, you own the stock to be called away, you collected the cash in advance, and it only gets exercised if the stock moves up or whatever your price is. But selling calls does not completely hedge your portfolio against a loss. In the example I talked about earlier, that $50 stock, if you sell a call against it for $2, you're hedged down to $48, but you're not hedged below that. So if that stock drops from $50 to $40, well, you're still down $8. Now you can sell another call against it to recoup, but the problem you get into is a downward spiral on the price. My point is that yes, selling calls can generate income on the stocks you have, but it doesn't mean you don't have to do thorough research to make sure the stocks you own are legitimate long-term stocks. It also isn't going to hedge out market risk. If you're selling calls and we get a market decline of 10, 15, 20%, that's going to take all stocks down with it. And your calls won't cover you for that full amount. So when you hear these strategies touting 2, 3% returns a month, be very wary. I'd hate to see you get hurt thinking that, wow, I found the end-all be-all of investing. You haven't. In fact, covered call writing is not something institutions do as a rule to generate returns. They use options more to hedge positions. The reason for that is you do limit your upside. Let's assume that you have a $50 stock and you sell a call at a 55 strike price. Well, that means the most you can make on that stock is $55. If it goes to 70, well, you're capped at 55. So you've limited your upside. You've hedged your downside a bit, but you've limited your upside. And so be aware of these. Talk to your advisor, your broker. Maybe you've got some stocks you want to execute a covered call strategy, but you want to be very careful that you're doing it with stocks that A, you don't mind selling, because if it gets called away from you, you sell the stock. And B, stocks that you think are fundamentally sound and not likely to go down precipitously. In addition, as we've talked here, the fact is in 2015 coming up, you've got a situation where the Fed is going to be raising rates, and that probably will cause the market to correct. Using covered calls does hedge you a bit. Be aware of that. But there are other ways to hedge market risks, and we'll talk about those in future Masters of Money. We want you to be aware of those, though. So the covered call strategy, if you hear people talking about it, just be aware. Yes, it works. I know a lot of investors I've known have made a lot of money selling calls against stocks they own. It's a good strategy, but it's not the end-all be-all. It's a strategy that works well in certain circumstances, but not in all. So again, on those, make sure you send us questions at safefinancial.org as we go through that. Now, last week we introduced you to the stock of the week that we're going to be doing from our friends at Superstock Investor. And we talked to you about Ford Motor Company. That was our first update. And we're not so much out to make a recommendation of Ford for you, but we are out to educate you on how to look at these things. We talked about momentum and how Ford had traded off. And so you could see there was a possibility of a bounce back. We talked about its valuation, that it's selling at a relatively low price to earnings ratio. This is a kind of a company you might want to look at. Well, the fact of the matter is, in the last week, that stock popped up 7.8%. That's a nice return for a year for most people. But a lot of that's predicated on the market, but also the fact that Ford has just built their F-150, and they just began production of it, and that's a hugely popular product for them. So the Ford Motor stock that we talked about, again, talk to your advisors about it, talk to your brokers about it, make sure it's suitable for what you do. But it's a way to look at stocks that we want to teach you. We want to teach you what key variables to explore to make sure that when you're buying a stock, you're on the right side of that equation. Well, this week we're going to go into the technology sector, and specifically we're going to talk about Cisco Systems. Now, Cisco is a major company in the technology arena. We want to talk about them because we've got a stock now that trades at about $24 a share. I'm going to put some numbers up here for you. You can see the current price is $25.33. There is a price target from our friends at Superstock at $29, which is a potential gain of 14%, with an upper limit approaching a 42% return. Lower limit, the downside they think at 7.4. Now, they get some of that through the fundamentals. The price-earnings ratio is only 8 times, which the market's at 15, so it's about 1/2 of the market's PE, and their sales growth is almost 7%. Very, very strong. If you look at their profitability here, their future profitability, current and past, are all very strong, and their asset growth is up over 10%. This is a very strong company. We think Cisco is one that you might want to watch again. It's the type of company, when you see valuations like this, price charts like this, as well as fundamental growth rates like this, oftentimes you'll see these companies outperform. Well, Cisco's one of those. So this week, we want to thank our friends at Superstock Investor for giving us the idea to take a look at Cisco Systems. Now, so tonight, we've talked about something very complicated. In fact, it's probably the most complicated Master of Money show we've done. But we'll bring it down next week, by the way. But we talked about options, call options, put options, with a little emphasis on covered calls. Very important strategies for you as you go forward building your path to prosperity. And we hope that whether you invest in them or not, you'll learn this so that when you sit down with your banker, your broker, your investment manager, you know the language that they're speaking. Half the battle is just being literate in the language of finance. So we want this to be part of your quiver as you go forward. And we talked about how these options can be used to juice up your return, certainly, especially the covered calls, but also hedge a little bit of your market risk. We think it's important, and once again, I urge you to write us at questions@safefinancial.org. That is probably your best friend tonight. Now, we are written and produced by the Society to Advance Financial Education, a not-for-profit organization dedicated to providing you the knowledge and tools you need to build a thriving and prosperous life. We hope you enjoy the program, and if you do, there's a GoFundMe button on our Society site. We hope you'll click it and maybe make a small contribution to the Society. We work hard for you, but we do live off the generosity of people just like you. I want to thank Ron Blake Music. Ron is an interesting guy. He's a fabulous friend of the Society's. He's a believer in the financial education we're doing. He also happens to be the lead saxophonist for the Saturday Night Live band. Well, Ron allows us to use some of his music in the opening sequence. So as you're listening to our program before we start, that beautiful jazz music is done by our friend Ron Blake. And I want to thank Ron for allowing us to do that. And at the end of our show is what's been referred to as my theme song. It was written and produced by a friend of mine named Chris Yance. And I want to thank Chris for his putting that together. I do want to thank Harvest Financial Services for allowing us the use, as always, of their facility, and Superstock Investor for giving us their idea of the week. We look forward to seeing you next week. We welcome you to visit us through the week at www.safefinancial.org, or as I said, up on Ustream at Safe Financial. We hope that we give you the information you need and can interact with you each and every day. Well, thank you. Have a great week, and we'll see you next Tuesday for another edition of the Master of Money.